Hey, what's up, everyone? Welcome, Agents for Life, to podcast 244, where we're going to talk about all things IUL. If you're brand new and IUL means nothing to you, well, by the end of this podcast, you'll know a few things. I want to break down the good, the bad, and the ugly because IUL is not for everyone. It is a good, potentially good product, but we have to be careful talking about IUL with our clients. So I want to make sure I reiterate some points, especially if you're a newer agent and you're all fired up about this product. So we're going to break this down just a minute. But before I do, just a quick reminder. I have now in the email at the bottom, that resources tab, a link for you to schedule. If you're brand new and you need some help on your first appointments, you can schedule right on my calendar and I'll help you with those. So take advantage of that if you feel the need. And second announcement, Ohio, August 23rd, 24th. This is a hands-on workshop. Anybody that's in driving range of Ohio, this is Eric's pad, so to speak. We're crashing at Eric's pad. How about that? No, it's his office, and he's got a lot of room. And I'm flying out there, so I'd love to see all of you, especially if you weren't able to make Dallas. Love to see you there. So put that on your calendar, and if you can make it, you'll be glad you did. Mic drop thought for the week. I love this. This is just something that I don't know if I heard it from somewhere or if it just kind of ruminated around in my brain and came out this way, but life begins when your fear of not realizing your potential overshadows your fear of failure. Pretty deep thought, right? Think about that. We have a lot of fear of failure, fear of reaching out, fear of getting rejected, right? Fear of running an appointment and having this person say no or whatever, fear of not getting paid, fear of not succeeding, failure. Well, when your fear of not realizing your full potential outweighs fear number two, that's when life begins. Because why? That new fear of not, that's a righteous fear, right? Not realizing your potential. It's a bigger fear. And all these little mini rejections along the way, they just become white noise because that's fear number two. And we don't even care about that, right? That's just part of the journey. So I hope that helps somebody. I don't know who needs to hear it, but that's a deep thought for somebody. But let's jump into IUL training. Okay, so I've been studying IULs for many years since I first got in the business. And I've come to the conclusion that they're really not for everyone. And I wanted to explain why. An IUL can be a really good vehicle for people. Okay, a couple of things though. IULs are not inexpensive. If they're done properly, they're going to be a pricier item. So most people, it's not going to fit comfortably in their budget. Or if you back it down and fit it comfortably in their budget, it's not going to perform well. So an IUL has components to it. It has cash value. Okay, so when you pay in your premium, some of that money funds a cash value account. Some of that money purchases a death benefit, and some of that money goes toward cost of insurance. Cost of insurance. Okay. And when you're young, that cost of insurance is low and your death benefit is cheap. And so a lot of your premium is able to go into the cash value side. Well, this builds up a nice, gets a nice base going, gets some good momentum going, so that in your later years, when that cost of insurance has gone up, you've got enough momentum to carry you past so that you've got the growth of the policy, the money in that cash value is growing at such a rate that it's outpacing the cost of insurance. So you've either got to do that with time or with dollars. Okay. And if you're young and you set up an IUL, you can get time on your side. And by the time you're in your 40s and 50s, when that cost of insurance starts getting expensive, you've got enough momentum that it's okay. You can weather that storm. But if you got an IUL in your 50s or 40s and you're in your minimum target funding it, it's probably not going to last. So here's what happens. An IUL's health is based on the cash value inside of it. Because when that cash value hits zero, the IUL is going to lapse. And the insurance carrier is going to send you a little letter that sounds like this. Your policy is about to lapse because the cash value has hit zero. If you'd like to keep it, you're going to need to refund it. And the minimum amount of that's going to be 2,500, 3,800. It's going to be in the thousands. Okay. Most people are, at that point, kind of just letting the policy go. They can't. And I've talked to a lot of folks that have been in this situation or that are on track to have this happen because the agent that wrote the policy either set it up underfunded, not enough cash, not enough premium, or just too light on the funding. Anyways, so when you set up a policy, an IUL, okay, if you're designing it for cash value, if the goal of the customer is the cash value in that account, because they saw some ad that compared an IUL to a 401k, which by the way, I'm going to tell you, don't ever do that, and I'll tell you why in a second. But 401k, IUL, they pick the IUL and they're all excited, right? And they start funding it, but the agent that put them in did it a disservice. So you can custom design it, and you should. If you're designing an IUL, you want to max fund it, and you want to minimum death benefit, because that's the lever. The more you put on the cash value side, the less death benefit. So if you have an IUL that has a lot of death benefit, it's not going to have a lot of cash value. So you have to figure out what the client's goal is. What do you want from this policy? Do you want cash value or do you want death benefit? And sometimes you'll get somebody that kind of wants an even mix of both, but usually somebody wants one or the other. Okay. My rule of thumb, this didn't come from anywhere else but Street of Hard Knocks and experience. Okay. My rule of thumb, $100 for every decade of age. So if you're in your 20s, I would say minimally you want to be funding your IUL to the tune of $200 a month, minimally. $300 for in your 30s, $400 in your 40s, et cetera, et cetera. So, and there comes a point when it just doesn't make sense. An IUL is best long term. By long term, I'm going to say at least 15 years on the minimum side. Better if you can keep it going for 20 years or more. So if you're talking to somebody in their 50s or 60s, and they're planning on retiring at 65 or 70, an IUL is not going to be a great vehicle. The first 15 years in most policies are a surrender fee. And if they were to, so it's going to block the amount of cash value they can have access to, because the amount you have is the surrender value, not the full cash value. So if you want to borrow money against it, they will subtract out the surrender costs from your cash value, or from the amount you have in the cash value. So the surrender charges are in the early years, and it prorates over time, so it slowly goes down. But there's a couple of other things you need to know about an IUL. It does have costs in it, and those costs go up. So I was reviewing one of my clients this last week. She has a Forester's policy, and I went over with her all of the costs inside of her, just a universal life. It was a smart UL. And in the early years, those costs were low. The death benefit was low, and she had a lot of extra. So that lot of extra was going to the cash value side. But she's kept her premium the same over the years. Now, I didn't write the policy myself. Another agent wrote it. So I don't know if the agent put it in at, here's the max, which we call the MEC limit. Here's the minimum. Below this, they don't have a policy. There's not enough to sustain it. And as an agent, you can fund it anywhere in here to start the policy. And then the client is likely to just keep funding it at that level because they don't know they can increase it up to the max, or they can decrease it if they want, although that's usually not recommended, right? So over the years, if you're not reviewing that coverage, you could easily be funding it a little over the minimum, okay? Target premium, we'll call it, kind of in the middle. But costs of insurance slowly are going up, and pretty soon your premium isn't covering the minimum anymore like it used to, okay? Costs of insurance go up. You're still paying here. Costs of insurance going up. You see what I'm saying? Until it hits this, and then it starts eating itself. So it needs something to sustain it. And if this actually, anytime it's above this line, that difference, it's going to pull from where? The only place it can, your cash value. So little do you know, unless you're watching your annual statements, that cash value is slowly going down over time until it hits zero and the policy lapses. So an IUL has a lot of moving parts. And when I describe an IUL to a client, or even a universal life, very similar, just doesn't track the market, the growth with a market. So when I come across a client that wants one, I go in a little skeptical because they may have seen something on Twitter and or X, I guess. I don't know what is the social media of choice nowadays. Mine's Facebook, but Instagram, whatever. And there's some ad, and somebody says you can get a 401k or you can get an IUL. First of all, it's not fair to compare the two because they're totally different vehicles. Okay, one's a one's a car, and the other one's totally. Sorry, bad. That didn't go anywhere. I was trying to make an analogy, but it didn't work. Yeah, but they're different. You can't compare them. It's apples and oranges. So what you have to do is separate the two. An IUL is think of it more as a savings vehicle, a place to store your cash, just like infinite banking. It is also not an investment. It is a life insurance product. We are not financial advisors. We don't handle investments. So first of all, it's not fair to compare an IUL to a 401k. Now, there seems to be a lot of temptation to compare because there's a lot of similar. It's got growth. It's got it's growing, tax benefited in some way. 401k has fees and IUL doesn't, and 401k is for retirement, and IUL can also be used to help supplement retirement. So, but be very, very cautious when you're describing IULs to folks that you don't overpromise or misrepresent what it is. In no uncertain terms, an IUL is life insurance. Its primary job is to protect someone in the event of somebody dying, just like life insurance does. Okay. A 401k, an IRA does not do that. It is not life insurance. Its job is to grow and build, a lot of money over the years so that you can have some kind of retirement. So don't try and make an IUL a retirement vehicle. Okay, that's first and foremost. But secondly, when you do talk about IUL, because of all these moving parts that I've described, and hopefully I'm not overwhelming you, if I am, sorry. But if it's too much, if there's a lot of moving parts and you have to watch it. So an IUL, this is what I say to a client, is not a set it and forget it kind of a product. Okay, like term or whole life, or final expense. There's a lot of products that are locked in, guaranteed, never going to change. Okay. Well, you can just drop it in your drawer and you're good. A lot of people do that with your term insurance, right? Till 20 years later when it expires and you go, oh, I forgot to pay attention to that. That's another topic for another day. But an IUL is hands-on. They send you an annual statement for a reason. You need to open that. You need to look at it. You need to see how that cash value is growing. You need to see how the costs inside the policy are stacking up and increasing, and if you are still coming out positive, or if you need to increase your premium. Okay, they're flexible, they're not guaranteed. So there's a lot of, and I sound like I'm coming down on IUL. I have an IUL and I still sell those. I just sell them very cautiously because it has to make sense to a person. Now, you have custom designed IULs, like what we do with Fidelity and Guarantee, or Columbus, or a lot of different carriers. However, you also have express products like Americo, I think, has one. Certainly Mutual of Omaha, Index Universal Life Express, and who's the other one? Oh, Ethos has a new one coming out now. So Express is convenient. It helps a new agent be able to write IULs without having to go into that fancy underwriting software, design software for illustration. So it does have a convenience component, but because it's Express, it's not going to do either a great job of either one, cash value or death benefit. It's going to have a little bit of both. So it's kind of trying to do all things in one product and try and keep both sides happy. So if someone really wants cash value, don't do an Express product. Or if they only want death benefit, don't do an IUL, do term. That's where you can get the cheapest death benefit, right? So make sure that you're recommending products based on what your client wants. That's the key. And if you're not quite sure how to talk about IUL or how to present IUL, please just don't go into a discussion and try and fake it and write a bad policy on someone on accident, because in 10 or 15 years, you might get that nasty phone call. And even if you're not around in the industry, you still don't want to do a disservice for somebody. So make sure that you're careful with IUL. Make sure that you're very upfront in the costs, that it's moving part, that they need to increase their premium over the years, very likely. And and if you are writing an express product, it's better when it's compared to a term. So if you had term, here's how I would write an express product if I were to write one. I don't write very many, but if you were to compare a term, which builds no cash value, with a little bit more money, and you get an IUL, which has the potential to grow a cash value. Mutual of Omaha Index Universal Life Express has a 30-year guarantee in it. So it's guaranteed to go for 30 years. So if you compare a 30-year term with an index universal product, 30 years, I should say, or age 80, it's not going to be that much more for the IUL, and you have the potential upside. But worst case scenario, you lose all that cash value and it ends up being like a term. Okay. So are you okay with paying a little bit more and have the potential upside of some cash value over the years? Okay. When you show an illustration, you have to be careful that it's just an illustration. Those are not hard facts, and very few. No, actually, no illustration performs exactly how it's because you're guessing. How can you predict the future with 100% accuracy? You can't. So we do the best we can. They try and be conservative. They show the guarantee column, and I always show that to a client before I sell any IUL. They have to know that the guarantee is that it could not perform and maybe only last 10 years, and you're paying a lot more into it on the guarantee side because the guarantees aren't very good in an IUL. Or it could do this, but it's speculative. We don't know. So those are the risks. Now, don't think by all this that I'm saying that I'm just all negative about IUL. It's not true. I just want you to be careful. I want you to explain this stuff to people. And I want, if you're unsure, I want you to put them on my calendar or somebody that knows an IUL specialist that can handle that discussion very well, and let us run those appointments for you so we can explain this to your client. Because when it is a good fit, it can be great. Okay. But it just isn't for everyone. And that's the point I wanted to make is it's for some, but it's not for everyone. So I hope this is helpful. If you're new and you're brand new to IUL, there you go. You might want to play it a few times so you can have some of that set in. There's a lot more content that I wanted to talk about IUL, but that's the gist of it. And those are the hot points that I wanted to cover because that's the stuff I see on a day-to-day basis when talking to clients and hearing from agents about the topic of IUL. So hope that's helpful. Thank you for listening, and go out there and be the best agent that you can. Be an agent for life. Okay. Treat the customers right. Be honest. Don't cover up for a commission. Okay. If it's not a right fit, don't recommend it, but learn about these products so that you know what you're recommending, or lean heavily on your mentor and let us help you so that you're putting the clients always, always, always doing the best for the client and putting them in the right product for what their goals are and what their needs are. Thanks for listening. I'll talk to you next week. Bye.